Good morning, hello and welcome to Opening Bell. You're with us on Moneycontrol. I'm Surabhi Upadhyay. It's Tuesday and the IT or the tech tremors are being felt around markets pretty much all across the world. That's the big headline this Tuesday. There's plenty to go over. We've had a big drop once again in US technology shares, particularly in companies that provide cybersecurity. And you can pin it all back to one entity called Anthropic. So there's lots to discuss. Let's get started with the headlines. Wall Street slides amidst renewed tariff threats from Trump and fears over artificial intelligence disrupting various industries. The Dow tanks more than 820 points. The Nasdaq and the S&P 500 turned negative for the year. Shares of IBM and CrowdStrike sink as Anthropic rolls out yet another disruptive AI tool. Asian markets trade mixed on the back of the sell-off on Wall Street. Kospi rebounds from early losses to hit yet another record high, while Chinese markets resume trade after the Lunar New Year holiday. China's central bank keeps the benchmark lending rate unchanged at 3% for the one-year loan prime rate. Meanwhile, the GIFT Nifty is suggesting a lower start for Indian equities. US President Donald Trump threatens to impose higher tariffs on countries that quote-unquote play games with recent trade deals after the Supreme Court last week blocked many of the sweeping global levies. This comes after the EU postponed the ratification of its trade deal with the US due to the tariff uncertainty. Oil prices ease but remain at six-month highs ahead of a third round of nuclear talks between the US and Iran. Precious metals continue to climb over tariff uncertainty. Among stocks in news, Bharti Airtel will be in focus as it outlines a mega NBFC plan. The telecom major subsidiary is expected to be capitalized with 20,000 crore rupees over the coming years, with Airtel contributing 70% and promoter group Bharti Enterprises contributing the remaining 30%. Okay, so let's tell you a little more about this major AI disruption that was playing out yet again on Wall Street. First, the headline. We've got a major meltdown across the indices, so it was not limited to only 4-5 stocks. It took the entire market down with it. The Dow lost over 1.5%. The S&P 500 was down 1%, as was the Nasdaq. Now, before I talk about AI and what really happened with these tech stocks, the fact is that the risk-off sentiment was showing up in other asset classes as well. On the equity side, the CBOE VIX, massive surge there, over 10% increase coming through. By the way, the VIX was higher even in our trade yesterday. So volatility continues to be very, very elevated. Risk off in general, and that led to a big rally in gold once again. Gold is back. That is, spot prices are back above 5,000, and gold futures are back above 5,200, rallying back to 3-week highs because there's so much uncertainty on tariffs, on AI, on this whole tech transition. In fact, this showed up in the way the bond market behaved as well. The bond, the benchmark yields kept falling yesterday. The 10-year, the 2-year, the 30-year yields, all of them were down between 2 to 5 basis points. In fact, the US 10-year has now come back to 4.04%. What does that mean? There's uncertainty in the market. People have been selling off equity and moving to buy bonds. And when people buy bonds, bond prices go up and bond yields fall. And that's what played out in overnight action. Now let me talk about this tech meltdown. What is going on? It's again worries about how deeply AI will dislocate current software businesses. So case in point is IBM. IBM stocks were sold brutally yesterday. IBM plunged 13% as the market is now thinking that Anthropic can actually, Anthropic with its model Claude, it can start modernizing legacy systems which are running on COBOL. COBOL is a system that IBM invented way back in the 1950s. And now, there seems to be a lot of chatter around how Claude, which of course is made by Anthropic, can modernize some of these systems so you won't need them anymore. And that's why there was this big crash in IBM stocks. That wasn't all. Remember, on Friday on Wall Street, cybersecurity stocks were down. And that continued on Monday as well. And look at the kind of drop we're talking about. 7, 8, 9, 10%. CrowdStrike, Zscaler, Tenable, all of these stocks. Now, between Friday and Monday, they're down 15, 20, 25%, some of them. These are companies that provide cybersecurity software, cybersecurity systems. And again, the fear is that Anthropic's Claude model has, so many things built in it that you won't need separate cybersecurity software at all. So existential worries coming through, the market feeling very, very nervous and selling off. And by the way, another reason for the sell-off was the fact that today Anthropic is doing a big event. It's a mega event. It's a product launch of sorts. They'll talk about what more their model can do, what more can Claude do, and that's adding to the nervousness about what more will Mr. Sam Altman declare tonight. So watch for this space, and in anticipation, in looking at worries ahead of that, there was this big brutal sell-off. Asian markets are trading largely mixed this morning. China has resumed after the holidays, but largely, there is a sense of caution that's prevailing even in Asia. I'm checking my screen once again. So the Nikkei has been fairly quiet, gain of about 0.5% over there. The Hong Kong market is quite sharply lower. Hong Kong is down 1.7%. And Shanghai for the time being is managing a bit of a gain. In China, there was the interest rate decision, and the central bank there has left interest rates changed again. So let's watch for this. Now, where does this leave us? The GIFT Nifty is telling us that we'll probably start about 100 points lower. Yesterday, the rest of the market marched on, but IT stocks were under pressure. The question is whether we'll get another round, or whether, we've already seen a 16-17% drop in the IT index in February. So is it in the price? Will we get another slam dunk? Who's to say? But expect more volatility and maybe more pressure on IT stocks. We have to see if the other parts of the market, Reliance, L&T, banks, whether they can make up for the pressure that is consistent on IT. And all of this means that the market continues to be in a trading range. It's a broad range, 500, 550 points. So 25,450 is the lower end of that range. And 25,900, every time we get to that level, the bulls, develop a fear of heights. So let's see. And now we have this negative global headline on IT again. So difficult to say whether today is the day that the bulls can continue punching past this resistance zone. The good part is yesterday FIIs were buyers, though there were a lot of block trades as well, and big deals were happening. Big stocks like IDFC First Bank were moving. So you have to take that into account. But anyway, yesterday was a good solid buy figure, 3,500 crores almost from FIIs. Domestic institutions were on the sell side, sold off cash stocks worth about 1,300 crores. That's the setup. We're getting into a resistance zone with negative global cues. That's the headline. So what's the positioning? What should you be doing? Well, we've got our experts lined up. Ajit Mishra is joining us on the technicals from Religare Broking, and we have Dharmesh Kant, head of research at Chola Securities. Gentlemen, good morning. Thanks for joining in. Dharmesh, I want to open with you with exactly what I was just talking about, reiterating the fall overnight on Wall Street. So all these US tech stocks are down. The question is whether the worst of this fear is already in the price. Stocks are down 15, 16, 20% here in India as well. Or Dharmesh, do you see that there is another wave, a down wave or a leg down that is still possible till US tech settles?
Yeah, good morning, Survi. Thanks for having me for the show. I don't think the worst is still in the price. I will give you prelude of how this is panning out for Indian IT stocks in the country. So FY19, if you look at Nifty 50 composition, all the IT stocks which was in the basket did an aggregate PAT of around 70,000 odd crores. Come to FY25, it was around 110,000 odd crores. So the weightage in Nifty 50 in FY19 for IT stocks was around 21-22% on the profitability basis, which has come down to 12-11% as we speak. So, before Anthropic, the things were not shaping up well for Indian IT companies. They will, losing, earnings growth trajectory. And that was the challenge out there. The hope was that things will turn around as discretionary spend and interest rate cuts will help them garner the business from the BFSI segment in the US. Now, again, disruption is happening at a very disruptive pace. So the first challenge for Indian IT companies would be to secure the revenues or to replace the revenues with, system integration of AI modules into the new software. And through that, they would try to, just maintain their top line run rate, which I think it will be difficult. The blended realizations are going to come down. At the same time, your value addition is going to further come down far lower. So then the blended margins are going to take a hit. So, this entire thesis from low single digit kind of a PAT growth, maybe a couple of years down the line, we will see a negative kind of a PAT growth. So why to buy IT companies for what? And just because there's cash on the balance sheet and a dividend yield is high, I don't think but that would suffice the buying thesis. Then there are better utility plays in the FMCG segment. At least there will be some growth. So I am seeing this entire basket in that light. And I mean, the bounces will be there. Currency depreciation is the only factor which has been helping IT companies. But it's a sell on rally kind of structure for Indian IT companies as of now.
Wow. So Dharmesh, you're making it very, very clear that you're not in the camp that feels that these are, great levels to get in and add them to the portfolio. You're saying that sell the rallies, and if at all, it's only a tactical play, right? For traders, I mean, who want to trade in and
Definitely.
out, but not from a fundamental point of view.
Absolutely, sir. But that's the call on the IT companies.
Got it, got it. Viewers, I just want to, outline that the views are very divided on IT right now. We completely take Dharmesh's caution on board. And he's in that camp. Yesterday, remember, Jeffries had sold IT stocks in a big way. Not sold, I mean, they came out with their report. They downgraded the entire sector. They cut price targets very aggressively yesterday on IT. But this morning, we've got CLSA. And CLSA is in the bull camp. CLSA is saying that this is not going to disrupt IT permanently. They've come out with a bunch of buy recommendations. In fact, we'll play out those, Jeffries, those both the bull and the bear. So CLSA is the bull on IT. Jeffries is a bear, and we'll play out both the notes in just a bit. But let me bring in Ajit as well. Ajit, all of this has made problems for the bulls, compounded problems for the bulls, I would say, because every time they're going into this zone of 25,800, 900, something or the other is coming, and this IT worry refuses to go away. So how are you looking at the overall trading setup this morning?
Yeah, good morning, Sulbi. So, Sulbi, you're right. In fact, it's been third week, successive week, wherein we are seeing that index has been maintaining this range-bound bias, means 25,400 is acting as a strong base. While every time we reach closer to 25,800, 26,000 mark, we see selling pressure emerging. And that too when, barring IT, auto, banking, metals, energy counters, they are holding strong. So in fact, banking is quoting closer to the record highs. So definitely it's a concern that it's more of a sentimental dent that we have seen, every time we see that index is inching towards the record highs and anticipate at least there will be some stability in the IT pack. For IT index specifically, Surbi, we are close to April month 2025, April month lows. That is close to around 30,900 mark. And in case if we fail to hold this level, then probably we are set for further leg of down move despite the oversold position. So I guess that is a concern basically which is keeping the bulls on the edge, and we fail to see any decisive trend emerging in the market. Today being the expiry day, we feel that this volatility is likely to play going ahead also, since we are seeing a bit of a consolidation in banking, which was holding from one side completely. So it's going to be more of stock specific or sector specific play. When it comes to the market positioning, index might continue to trade lackluster in the near future.
So your trades are more on stocks rather than the index. I mean, so nothing on the Nifty or the Bank Nifty, Ajit.
Yeah, so for index, I feel that one should wait and let the market settle after the initial downtick, because yesterday we were seeing that market was making an attempt of recovery, but we could not surpass 25,800 mark. On the downside, 25,600 definitely is the immediate support, but we need sustainability at least in the initial sessions. In case if we see this trend continuing in the banking, then only we can take a call that yes, we can play for a rebound. Otherwise, stock specific approach is something that you should continue with.
Okay. Dharmesh, just a overall market question first before we talk about today's stocks, and there are several interesting names in news today. On the overall market setup, I mean, what's the sense after Q3? Because results have, I think, largely been fairly okay, and most people are still retaining their expectations that FY27 will get at least 12 to 15% earnings growth. So what are you thinking about the rest of the market and the way we are positioned now after third quarter?
I think the broader market is positioned very sweetly. I mean, this kind of a correction is giving you a very good opportunity to buy quality stocks. And though the sectoral, biases have changed, so the clear winners to on a sectoral fund is one is the banking space, particularly in the PSU banking space. NBFCs came out with a very strong set of numbers. Automobile, auto ancillary, metals, they all came out with a very good set of numbers, followed by specialty chemical segment. So these are the few sectors in place where largely the numbers were very good. We were working around 1250 kind of a Nifty EPS number for FY26. The way the run rate has panned out for Q3, I do think that we will hit there. And then 10-12% around 1400 is the EPS target for FY27, which is again likely to be on the cards since the tailwinds are playing out. So gems and jewelry, they have moved quite a bit, so we are avoiding that. But again, the traction is likely to be out there. So particularly what we have been, focusing largely on in the corrections, public sector banking space, we are a buyer out there and we continue to remain. I mean, SBI and Bank of India remains the top pick out there. Even in the private sector banking space, we are liking Axis Bank and IndusInd Bank. Just on the valuation perspective, both looks pretty attractive. IndusInd Bank likely to be a turnaround, and metal is our play for Berivars. Every decline should be bought into with our domestic centric metal space. So Hindalco and JSW Steel. So these are the companies which we are focusing on as of now. So we are looking at corrections to buy automobile and auto ancillaries.
Are you looking at the corrections to buy auto and auto ancillaries?
Yeah, I mean, there also a good run rate has been there. Even January month, the sales number for all auto companies, particularly on the two-wheeler side, panned out very well. And we think that, for example, Bajaj Auto, both the triggers are likely to factor in both domestic and international sales as well as the currency tailwind. So there are a few companies which are looking pretty attractive. Only the EV basket, where there was a lot of enthusiasm, euphoria. I think that will take a backseat. ICE will be the one which will be making more of a hay in next 2 to 3 months kind of a time frame.
Okay, all right, got it. By the way, I can see a couple of queries coming up. Viewers, morning to everybody who's joining us on our live YouTube feed, live stream. Tyagarajan, hi, good morning to you as well. Paddy, I think you need a view on Manappuram Finance. And there is Varsha, I think, who wants a view on Canara Bank. We'll come back to you. Our experts are with us. So Ajit, I'll request you to start looking at some of these charts because people want a view on financials, it seems, this morning. Manappuram Finance and Canara Bank. I'll come back to these questions, but we have to address today's stocks and news as well. And then we'll look at some of the viewer queries. So let's tell our viewers which are some of the most interesting stocks worth keeping on our radar this morning. Let's start with Bharti Airtel. That was a big announcement that came in. They have very aggressive plans on expanding their NBFC business, which is Airtel Money. Now, Airtel Money is going to be capitalized with 20,000 crore rupees. And this investment is coming in from Airtel. 70% will be Airtel, and Bharti Enterprises will be holding the remaining 30%. Airtel Money received the NBFC license from the RBI on the 13th of February. So now the group is really scaling up, full steam ahead on their NBFC plans. Let's talk about BPCL. Now, such great news coming in for BPCL. They've got a tax order. It's a pretty big one, actually, worth about 1,800 crore rupees, 1,800 crore rupees. This is from the Central Excise Department, Kochi. So let's see how this goes. There are a couple of F&O exclusions. The Bombay Stock Exchange will be excluding Hudco, Piramal Pharma, Tara Tech and Torrent Pharma from the F&O, the Futures and Options segment. And no new contracts will be taken on these securities from the 4th of May. So no longer in F&O on the BSE. Watch for these names as well. Patel Engineering has been declared the L1 bidder for an irrigation project. The value is about 133 crore rupees. Signpost India has received a very interesting order from West Bengal. It's a 450 crore rupee order from the Kolkata Municipal Corporation, and now they get advertising rights on Kolkata's famed Park Street, which is, very, very prestigious. So watch out for Signpost India. Let's see if there's any flutter on the stock today. And some other order win announcements, smaller companies. The Pace Digitech, they've won an order worth about 160 odd crore rupees. Chalet Hotels is going to be developing a luxury property in Hyderabad for 633 crore rupees. So from the hospitality space, watch out for Chalet. So these are some of the, the smaller names that are in focus today. There's also one MobiKwik Systems, by the way. It has received the BSE approval to commence its stockbroking business. Not that stockbroking stocks have done too well of late, but for what it's worth, we'll keep it on the radar. One MobiKwik Systems will be getting into stock broking soon. Okay, so let's get back to our experts with some of these questions. Let's get your view on Airtel first. Dharmesh, what did you make of this announcement? I mean, that's a huge sum of money going into Airtel Money. How would you view the development?
I mean, the development is positive, so we have one more business foray, and they have been doing this. They have been building on the AUM, and I mean, it's too early to give an SOTP-based kind of a valuation multiple to this. Let it take its own course. Maybe 1 year down the line, a more meaningful SOTP valuation can be worked out. But Bharti itself has been doing fairly well. Both the businesses, be it India business or the African business, have picked up very well. And ARPU in African business is also now catching up. So blended is around 256, sorry, 259 for the Indian business ARPU. But slowly, I mean, African business, if it catches up to 230 to 40 kind of an ARPU, the revenue, I mean, the profitability run rate on the Bharti Airtel itself will be around 25-26%. It's expensive, it will remain so, but I think given the choice between, the Geo platforms and Bharti, Bharti has been doing fairly well on the ARPU front. So, again, the direction is fine, it's priced to perfection, no scope of error. So, the clients can be bought into. If you're invested, stay invested. That's the call on Bharti Airtel.
Okay, all right. So stay invested in Bharti Airtel. That's the view. Fine. Let me take up a couple of these viewer questions now. So like I mentioned, Paddy wants to invest in Manappuram Finance for the long term. He's saying the Bain capital issue is done. So yeah, they've got the approval and Bain will come in as a promoter of the company. So he's saying what would be a good price to buy in for the long term. Ajit, if you could help him out.
Surabhi, Manappuram is anyways, quoting closer to the record highs, the outperformance alongside with the, steady surge in the bullion prices. That is helping the stock to hold around the record highs despite the volatility which we are seeing in the market overall. For fresh entry, a level close to, let's say, 290, 285 would be the zone where he can consider, accumulating for the long-term basis. And 270, 65, that's the long-term base now for these stocks. So as long as it's holding up at this level, is continue to stay put.
Okay. And Canara Bank. In general, PSU banks have done well, Ajit. So a view on Canara, and even apart from Canara, if there's anything else on which you'd look at taking a long trade.
So yes, Canara Bank, in fact, we have a recommendation running. We have recommended to clients around 150 area, and we are inching towards the record highs. 160, 65 is broadly the zone where we have the resistance place. These call writers are active. But the overall trend looks positive. So definitely you can continue to stay put. You can buy fresh also with 150 as a stop loss and 165, 170 as a position target. Apart from that, Indian Bank is outperforming within this space, means the stock is anyways trading at the record high. Yesterday, it was a very strong day with volume. So after this consolidation range breakout, I'll not be surprised that the stock can gradually inch toward 1050, 1100 levels. So here also one can look for long positions with 940 as a stop.
Okay. By the way, the pre-open session has just started. So let me take stock of what's going on. Though we have to remember that these are just initial moves coming through. Nifty is down about 140, 170. It's all over the place right now. Very early. And no surprises here. You are seeing a shade of red on most IT stocks early this morning. So TCS 4.5%, Infosys 2%. Like I'm saying, let it settle. Right now it's barely like a minute into the pre-open session. But in general, there is caution. There is uncertainty and there is nervousness around IT stocks. There's no taking away from that because the mother market itself is seeing such carnage on whether it's cybersecurity firms, IT software companies, SaaS companies, and it's just not ending. So watch for that. Let's get the Nifty IT index. Let's get some of the IT stocks up. So if you see the Nifty losers, you'll see a lot of IT names on it. Apart from IT, what else? We've got Interglobe shaving off about 1.5%. Reliance is weak in the early trades. As you can see, they're down about 1%. Mahindra and Mahindra, ITC. These are some of the other names on the way down. HCL Tech Mahindra down about 0.5%, thereabouts. Bajaj Auto is suddenly showing up a negative rate, but maybe it'll settle. So let's just wait for it. Bajaj Auto right now is showing down about 4.5%. Let me see what's working on the upside. Now I'm looking at the Nifty winners. What is keeping the other side intact? Financials. So Shriram Finance, Axis Bank, HDFC Bank. Largely speaking, a lot of financials on the green side of the screen in the pre-open. This is how it's playing out for the time being. Let's do a quick check on some of the mid-cap IT names as well. Names like Persistent, Coforge, and see what they're doing. Hexaware, for instance, is already down 4.5%. So that's the problem. If you see the mid-cap losers, you'll see IT names there as well. beginning to build up. So we need to watch for this, a little cautious. But remember, there is a bull and a bear camp on IT, and we're going to get to that in just a second. So those are the early rates. The Nifty is now stabilized. It's only a 40-point drop because remember, financials are supporting. And let's see if we get any of the IT buyers to come back in as well. So that's how this is playing out. Let's wait for the rates to settle. We'll keep flashing, of course, the major movers and shakers on your screen. This is the story so far. Talking about financials, what did you think, Dharmesh, of yesterday's mega move on IDFC First Bank and AU Small Finance Bank? Obviously, a lot of nervousness because right now the bank has said that the quantum of this fraud is less than 600 crores, but there's still a forensic audit on. What would you advise on both of the stocks, which were slammed yesterday, AU and IDFC First?
So, I mean, first on IDFC First Bank. So, I mean, there was a fraud out there, and it's a significant compared to the size of the bank, which is there, almost 1.2% rent on the net worth. And the fact remains, be it teaming and ladding or collusion employees, with all the systems in place, it still took place. And it was reported to them by the outside agency. I mean, has the bank itself, identified the fraud? And then they have come out with a disclosure and they are taking that, corrective steps. It would have been far better. But this checks and balances has to be reworked. And definitely, what happens with a bank like IDFC Bank, which is coming up the ladder, such kind of, events unsettle the trust of the depositors into the system. So, I mean, Haryana government is already de-paneled. Others flow or the inflows will take its own time. And it was struggling with the entire microfinance and other problem in the asset basket. So less than 0.5 times of ROA. So the struggle will continue. But we have advised to stay away from IDFC First Bank because there was a lot of queries to buy or not to buy. So we are very clear not to buy. AU Small Finance Bank is a different story here. So I mean, again, they are checking the system out there, but the management has clarified that fraud has not been there. But I mean, the verdict is awaited. But there, I think the quantum is around 47 odd crores. So if things come out clear, then definitely that merits our attention at lower levels of price correction because there has been sharp runoff and the migration from small finance bank to a proper universal bank will itself take its toll on the growth rate. So 30% kind of a AUM growth rate or 25% will not be there. It will come down to 18-20%. And then has to be some correction on the cost to income ratio. It has to improve. If they are able to do that, then I think from a long-term perspective, 3 to 5 years is a good value buy. So it's a portfolio buy as far as the US Small Finance Bank is there as of now. But let's wait for this clarity to come by.
Okay, all right. So AU maybe yes, but IDFC First, you're saying that you're not rushing in to buy just yet till there's clarity. Got that. Ajit, before we let you go today, your top trading ideas, I've taken your advice on board. You're saying that don't get too bogged down with the index and trying to find an index trade. Look for stocks. So let's talk about the stocks then.
Yeah, so Surabhi, pharma names, they are looking comparatively better. Means structurally, we have not seen much yet, in this entire consolidation also. Dr. Reddy's, in fact, we have a fresh break after almost 1.5 years of consolidation. So we believe that gradually the stock has potential to inch towards record high. So one can accumulate even at current levels. 1250 should be a stop area and 1420 is what we are eyeing as a immediate target. Another defensive name in case if somebody is aligned for more for long side position, then Godrej Consumers from the FMCG basket wherein we are seeing strength. Stock has formed a base around the moving averages ribbon, and we feel that the downside seems capped considering the market scenario that we are seeing excessive volatility across the board. Choosing the low beta counters from the defensive space looks more sense. With stop at 1190, one can go long in Godrej CP with 1285 as an immediate target.
Okay. All right, got that. Ajit, thank you very much. Good to have your perspective today. Very, very helpful. Let's see if the market can find its feet and whether the bulls can weather this continued IT volatility. Thanks for joining in. You have a good trading day. Dharmesh, request you to stay on for another few minutes. We have some final questions before we let you go. By the way, I'm just checking what's happening with IT stocks because now we're about 7-8 minutes into the pre-open session. And the pre-open session is not too bad for the time being. The Nifty is about 70 points lower. And on the IT side, what do we have? We have about a 2% drop on Infosys. HCL Tech is down about 2%. Tech Mahindra Wipro 1 to 1.5%. This is where it's kind of showing up. And on mid-cap IT, so yeah, that's a Nifty IT index, down about 1.5%. On mid-cap IT names like Persistent, Memphis, they're down between 2-3%. So it's not like a absolute crash or fall because prices are already beaten down so badly. But yes, it is another leg down. There's no recovery for sure because of everything that seems to be happening out there. By the way, I just want to now point out the brokers. And like we were saying at the start of the show, that the bull and bear camp on IT is extremely divided. So let's get you some of the big broker calls. And today's call is coming from CLSA. And CLSA is actually sounding a fairly, if not bullish, at least not too bearish. What are they saying? CLSA is saying that their channel checks are indicating that there is no change in the IT service positioning in the AI era. They are noting positive management commentary. CLSA is expecting a macro upcycle in the current calendar year 26, and they're saying this macro upcycle will provide more opportunities to Indian IT services players. They're saying that this derating challenge and long-term growth assumptions, are something that we have to look at. They actually have some picks in the space. They like Tech Mahindra, they like Infosys, they like Persistent and Coforge in the mid-cap space. In fact, Coforge is their high-conviction outperform idea, and their target on Coforge is 2,278. HCL Tech continues to be an outperform for them as well, and Infosys is an outperform. So they've got a lot of picks in large-cap IT and in mid-cap IT, and some of those prices and targets are flashing for you. The targets might have been cut, but they haven't downgraded the stocks to an underperform or to a sell. They're still retaining their ratings on a whole bunch of them. HSBC's come out with a view on IT. HSBC is saying that 14 to 16% deflationary risk is there from AI over the next couple of years. What does that mean? That AI will come, it'll make systems far more efficient, and there will be productivity gains. Because of that, people who are doing business with IT service companies, Indian IT services companies, will not pay as much. So there'll be a downward pressure on pricing, and therefore that pressure could be 14 to 16%. But they go on to say that there will be proactive companies that will be offsetting this impact, this pricing impact, through new revenue streams by offering more services, AI-enabled services, and that could keep driving growth. So they see a favorable backdrop for IT spending overall in 2026. And then, of course, we'll flash yesterday's Jefferies note. Jeffrey actually was sounding extremely bearish. They cut down price targets across the board in the IT sector yesterday, saying that there will be a big implication, and this shift can impact business models. It can impact just the way the managed IT services universe is shaped up, at least as of now. And that's Jefferies. A bunch of downgrades that came in yesterday. So, Dharmesh, a quick final question to you. You're very clear, right, that for you, IT is a complete avoid. Mid-cap, large-cap, pretty much across the board? Or are you looking at any one outlier from a medium-term perspective? Purely if someone has a holding capacity for a year plus?
Yeah, definitely, yes. See, so even if you look at CLSA report, what they have done, they have cut down the target price. That means they have done a PE squeeze. So derating is clearly out there. And definitely they are also seeing a headwind playing out. So that's the reason why you are cutting down on the target price. Having said that, there's only one outlier which we have been banking on in the IT space, and that is Orion Post Solutions Limited. The company has been garnering orders quite well. So even last 3 months, they have garnered more than 78 orders, so both from public sector banking space, that is in the banking and fintech solution. They have an AI product to take care of that, and the 3 public sector banks they have garnered order from. Then you have the mobility space, where all e-ticketing of metro railways, be it Bhopal Metro, Indore or Delhi, and all the orders are flowing in, and there are sizable orders out there. Data center has been the recent pick, so they got one data center order from IDFI Bank, one from overseas company, the name they have not disclosed, and the pipeline is quite strong. So 1750 odd crores of order pipeline is there. Plus, order book is there, and the pipeline is around 3,000 odd crores, which may materialize soon. So, I mean, the visibility of 25-26% kind of a PAT CAGR is very much on the cards. Price has corrected quite a bit. In spite of these news flows, the stock used to jump, but again settled down at a low level. So I think 920, 900 is a very good price to enter into. And even at 17 times PE multiple based on FY27 earnings, we are seeing a target of 1600 plus on this company. So sizable upside out there. It's a product company and not a SaaS company.
Okay, all right, got that. Dharmesh, great conversation this morning. Thanks for joining in and weighing in on this big IT debate, and also, of course, running through some of the other important stocks and news. You have a great day, and we look forward to connecting again soon. Thank you so much. All right, so that's a view from Chola Securities. And now to make sense of this non-stop IT sell-off, we've got Sandeep Agrawal of Solio, joining in once again. Sandeep, morning, and thank you for joining us again. I know we're troubling you. I'm sure business media is constantly troubling you because you're someone who's seen these cycles before in your earlier avatar, right? Now, what did you make of this? One day it is SaaS companies, then suddenly now there's this panic that, okay, cybersecurity companies will have nothing left to do because Claude is doing everything. And tonight there is this Anthropic event, so God alone knows what more they'll announce. What have you made of everything that's happening in the US around AI?
Hi, good morning, Sylvia, and thanks for having me on the show. So, there are two different things. One, I think last year, 14, 15 months back, when I was negative on the sector, I was negative because I was saying that for a sector which will grow at 4-5% in the large names and mid names, 8-10%, the peg ratios were 5, 6, 8 times. So that was very, very scary stage. And I thought that, from here, at least 40-50% correction minimum on the index level is warranted because AI will take away at least 20-30% of the efforts over a period of 5 years. So every year you will have 4% decline in efforts, and you have to get at least 10% new business to even grow at 6%. And that was the reason I thought that, at index level, we should have a sharp correction of 45-50%. And I think large part of that has happened. Yesterday's blog and all those things, I think, honestly speaking, for the first time, I believe that this is a positive because no one was willing to even touch the old architecture, COBOL and all, and we have never taken that value even in our terminal valuation. Now, if Anthropic, what they put in the blog, and if they are really able to understand and they are able to streamline, I think at least $1 trillion, $800 billion to $1 trillion opportunity will open up over next 10 years to streamline it, because every CTO wants to streamline. Challenge is everyone was worried whether it can be done in a rational amount of money and a rational amount of time. If AI can solve that, I think that is a very big opportunity for Indian IT and any services firm. So I first time in last 15 months feel little positive.
And you remain okay. So you're saying, because you were very negative on IT, Sandeep, when we spoke earlier, and you had anyway sold off all IT stocks in your portfolio last year itself. But you're saying you're turning a little positive on Indian IT companies now.
So I would say that two of the large cap, like out of all the large cap, they have corrected meaningfully. I think I don't see much correction in them from here, because maybe 5-10% I will not be able to call that bottom. But yes, I have some problems with some of the mid caps because they are insanely expensive right now. Also, there I still think another 25-30%. So total correction which I expected in the large name was 40%, 45%, and in the mid names I was expecting 65-70%. So large have corrected by 35-38%. So there is another 5-7-10%. I don't know where it is bottom. Mid cap, some of the names are still, I think, will correct by 25-30%. But broadly, I think the elephant is gone. The last, tail is left. So I am not so negative. I think, our business model is not such that we will see revenue declines. We will see low growth for long term. That is true, but not, a decline or something. So I am more constructive on IT services than the software piece. And I believe incrementally with little more correction, which can happen in next few days, I think, it will become very attractive.
Oh, interesting. I'm going to come back and have some more questions on that. So I think everything is good at a certain price. The question is, what is that price, right? That's the way the market functions. When you're talking about good companies, with good corporate governance, with big war chests, with cash. So since IT ticks all of those boxes, the question is how to deal with this technology disruption. So I'm just coming back, Sandeep. Markets opened. Allow me a couple of minutes. Okay, we've got a 100-point drop as the market has been trying to find its feet. Let's look at what's going on. So 110, 105, that's what the Nifty is doing, at least for the time being. The Bank Nifty is absolutely flat. The mid-cap index is down about 0.3% as well. Let's straight away fire up the Nifty losers, and you will find IT names on that list. So Infosys is down 2.5%, HCL Tech is down 2.5%, TCS, Tech Mahindra, Wipro. It's the first blow, really. I mean, when you wake up to US IT stocks and US cybersecurity stocks down 9, 10, 11, 12%, when you wake up to IBM crashing 13%, then the first cut will always be red. And that's what's playing out. The question is, do the buyers come in? Because IT stocks were down yesterday. And I mean, look at this. A stock like Infosys is down 20% this year. HCL Tech is down 14% this year. TCS is down 18% this year. So the question is, at what price, do you start hunting for some value? And that's the big debate raging on the street right now. Right now, it's still negative. Beyond IT, Eternal is facing a lot of pressure. Eternal is down 2.5% again. So watch for this one. Bajaj Finance, Bajaj Auto, Trent, BEL, Mahindra and Mahindra, Shriram Finance. That's a lot of red on the Nifty beyond IT as well. So unlike yesterday, where IT was really the only part that was lower, this morning we're seeing a more broad-based weakness. And financials are not providing the kind of support that the bulls would have hoped for. You can see names like Shriram Finance also lower, Bajaj Finance I mentioned. All of these stocks are down on the Nifty. Right now I'm still on Nifty names. You can see Midcap IT also down there, LTI Mindtree, Coforge. All of IT is down, so that's IT. But let's just come back to the Nifty for the time being, because the problem with the Nifty is not only IT today. Other stocks are also lower. And that's what's bringing up this 140-point decline. Titan, ITC, FMCG consumer names not really working. Reliance is down about 0.3% as well. ICICI Bank is lower. So financials are not providing the kind of support. Consumers are not providing the kind of supports. Auto itself is lower. So you don't have any batsmen holding up the other end. That's the problem. In fact, speaking of the other end, let's now pull up the Nifty gainers. Here, a couple of metal and commodity stocks come up on the screen. ONGC, because oil prices are still elevated. There's still a lot of uncertainty with what's happening in Iran. So about 1% higher on ONGC. Then there's Tata Steel, NTPC Power Grid from the power space, Coal India, JSW Steel. So largely power and commodities. That's what's up. Otherwise, the Nifty is having a bit of a tough start. Okay, now I'm looking at some of the mid-cap losers as well. And we were flashing those stocks, so let's come back to mid-cap losers. Persistent, Coforge, a lot of these names, L&T Technology Services, all of them are down. And then you have some financial names here as well. M&M Financial, for instance, is lower. Hexaware is down to 2.5%. Schneider Electric, Physics Wala, lots of names on the losing end of the screen. Let's see what's moving down on big volumes. Eternal definitely stands out. Trident, Lemon Tree Hotels, Bank of India, Railtel, quite a few PSU stocks also out of favor today. Okay, is there anything on mid-cap gainers? Anything worth highlighting? HEG slightly higher, Jindal Stainless. So again, it's metals, commodities, materials. That's where you're seeing some little bit of a green. But otherwise, it's a pretty, cautious start to trade, one would have to say. Watch for one MobiKwik. Remember, we told you when we were outlining our stocks and news today that it has received the license to start its stockbroking business. And one MobiKwik is rallying away, 9% up on one MobiKwik as it gets set to launch its stockbroking business. So we'll just pull up that stock. Those are the other mid-cap gainers, but one MobiKwik is the one that we should pull out. IDFC First, trying to recover, about 0.5% up. AU Small Finance Bank, about 0.5% up. That's the stock of the morning, really. On the gaining side of the screen, big move there, 11% and counting. So that's pretty much how the market is. And the Nifty is down about 140 points at this juncture. Okay. So Sandeep, coming back to just complete that argument that you were making, you're saying that at some point now, between here and maybe another 2-3 weeks, we're close to the bottom. Maybe this is not the bottom, but we're close to the bottom. Then the most critical question, what kind of Indian IT companies do you think will weather this storm? Do you think will be able to make that transition, make that pivot? So what kind of IT players? Large, mid, small? Give us, I know you won't talk stocks, but some clues, because you've studied these companies, these managements so closely in the past. Who do you think will manage to survive and thrive?
So Surabhi, I am very clear that, none of Indian IT services companies has any business model problem the way the US companies has. So I think, biggest destruction from the business model perspective, a 0-1 will happen in the US, primarily in the software side, cybersecurity side, all those companies, and they are going to fall very, very sharply. I feel a lot of those names are like, massively overvalued on the PEG ratio side. In fact, some of them are, the PEG ratios don't even exist because the growth will fall very sharply. But Indian IT will not have those challenges. As I said, we will have 20% deflation over 5-6 years. So 4-5% deflation a year, and we will get at least 7-8% new business. We will be 2-3% growth. But the problem is that, lower growth for longer. So, for 5-6% growth for 5-6 years, you cannot pay, 20 times multiple, 25 times multiple for the large names. You have some rupee benefit which is happening. So, maybe 15, 16 times, 14 times, 12 times is something where, you will start looking at them as a great opportunity. So I believe that, large cap between 10 to 15 times is where I will definitely be interested. And I think we are getting close to that. Mid cap, I would be very comfortable, at 18 to 22 times and not like, 30, 35 times, which some of them are still there. So I am very confident of the business model, zero negative, my view on that. But lower growth for longer. So PEG ratios has to be justified to make money. I won't go, more than 2 times PEG ratio, 1.8 times PEG ratio for large names, and more than 2.5 times PEG ratio for the mid cap. And I think we are getting closer to that. Some of the mid cap in ER&D space are extremely expensive. I think there is another 20-25% correction which is imminent there. But rest of the names are not so bad. And I cannot call out the last 5-10%, but I think in large cap 5-7% more correction, and mid cap 8-10% more correction, barring some of the ER&D plays. And I think we will make the bottom, and from there everything will look more reasonable and more realistic. And I'm telling you, we will not be surprised on negative growth for sure. I can assure you that much. I don't see any of the tech companies will have a negative slide of revenue and all that. I don't think we have that kind of business model at all.
Yeah, because the way the fall happened, it almost seemed to suggest that everybody is going to cancel contracts, saying, oh, we don't need Infosys anymore. We don't need TCS. ChatGPT will do the job, and Claude will do the job for us, right? So that's not happening, you're saying.
No, it will not happen. I have seen this industry for 25 years, and every time when disruption comes, it is more painful than this. Only challenge which I see in the sector, something should not happen on the execution side from, the client market, some kind of regulation comes. Those things we are not still building in the risk. Like, you don't allow execution, you make, some kind of charges, some kind of taxes on these things, then, that is not built in my opinion. In my opinion, today, what is built in is lower growth for longer, so lower multiple for longer. So I am more of PE derating, which has also happened 80% of what I expected. Another 10-20% PE derating can still happen from here. So that is broadly my view. I am not at all negative on job losses and all those things. I think new job creation will be lesser, but not worried about job losses. Also, I think mid-level will have to reskill. Good part is lot of tech platforms are absorbing a lot of mid-layer people. So, you are not seeing any big, hue and cry on the mid-level job losses also as of now.
Yeah, we live in hope and faith, and you're right, there will be a pivot, there will be a transition. And then you have, that's a great point, that there are platform companies as well. People who are well skilled in IT, they'll find a way, because that platform economy business, the internet economy business, is our own model. We've not discovered the LLMs, but we've got the whole gig economy. Everything is coming on mobile. We've got payments. So there's other formats of technology that India has kind of pioneered and adopted very well. So hopefully there'll be a place for all kinds of skill sets. Great conversation as always, Sandeep, and thank you so much for joining us once again. We live in turbulent times, and it's great to have you to give us some perspective and to shine a light when things are so confusing. Thanks for joining in. I'm sure we'll connect again. Let's see what Anthropic is coming out with tonight. And I'm sure in the next couple of days we'll have more conversations about the next stage of the disruption. Thank you. Thank you so much. You have a great day. Thanks. Okay. So just a word on the street before we welcome in our next guest. It's a wider fall, a 150-point drop. It's not one of those mornings where you thought 4 or 5 IT stocks will fall and the rest of the market will march on. The Nifty right now is at the morning opening low. It's only 9:30, so let's just wait and see how this plays out. But yes, there is some caution in the market. There's no denying that. And right now, no one's rushing in to buy. And even the other sectors, banking, other large names like Reliance or Airtel, etc. It's just generally a bit of a wait and watch kind of a opening this Tuesday morning. All right, so we'll keep getting you those rates, but for the time being, let's welcome our next guest on the show. Kunal Vora, Head of India Equity Research at BNP Paribas, is joining in. Kunal, good morning. So good to have you with us on Moneycontrol. You and I have spoken several times on CNBC in the past, but I'm so glad we can connect to meet all the digital audiences out there, because everyone's watching on their phones anyway. It's all about digital and all about IT. But Kunal, let me start right there. IT seems to have become a bit of a bad word in global markets overall. So before we talk about India and earnings and your strategy here, what have you made of this massive disruption sweeping everything from Wall Street to the Lal Street?
Thanks, Urvi. Thanks for having me. Great being here. So yeah, I mean, like say to start with, in case of IT services, I was recently meeting investors in Hong Kong, Singapore just a couple of weeks back, and that's when the carnage actually had started. From an IT perspective, we believe that at least earnings cuts have right now, like we've not really seen that happening, and valuations are looking a lot more palatable now. You have stocks like large cap stocks getting close to almost 5% dividend yield. And on FY27 itself, we have some visibility, at least commentary coming in from the companies seems to be reasonable. So from IT perspective, our analyst is positive. We believe that this is a good buying opportunity. However, when I wear my strategy hat, I just feel that there are better opportunities available elsewhere in India. Economy is doing well. We publish this monthly on economic indicators, and we see a lot of green there. And earnings growth also, we see much better opportunities on India domestic economy oriented stocks. So yeah, I mean, IT is something which we believe is more of a wait and watch right now, and there are better opportunities also in the market.
Okay, so a bit of a wait and watch on IT. Got that. So Kunal, now let's talk about the overall market. It's been a tough last, 15 odd months, right? And the thing is, Indian investors are not used to underperformance. And this has been a long period of underperformance. But where do you think we are in the cycle? And there are multiple reasons. One is obviously that the whole world wanted to move to the AI trade, and then Indian earnings weren't coming through, and then foreigners were selling. So it became kind of a perfect storm. Are we almost out of it? Are we somewhere in the middle of it? What do you see ahead?
Okay, continuing on, what I heard from the investors to start with, because that's something which I found, investors have become a little more receptive. If I talk about what I heard in November, 3 months back when I was traveling and meeting investors, the feeling was overwhelmingly negative. Economy indicators were not looking good. Earnings were getting lowered consistently. Trade deal had not happened. Currency was depreciating, and valuations were not looking great. India was not a part of AI trade. So quite a few negative views which I heard. This time around, the investors seem a little more receptive. They do acknowledge that there are a few positives now visible. Economic indicators are looking better. Earnings FY27 outlook is better compared to what we might see in FY26. Trade deals have happened. Currency is now stabilizing. So at the same time, the concern which still remains is India is not a part of the global AI trade. There are other markets like Korea, Taiwan, Japan, which have been doing very well. So investors seem to be of the view that India is more of a sort of not a market which is the top priority right now. At the same time, we have seen some positives. FII flows have, at least in the last couple of weeks, turned positive. But yeah, from a foreign investor perspective, India is still not looking like the top priority right now.
Okay, that's you're saying it as you're hearing it, right? So I can't blame you. But what's the reason, Kunal, that India is still not a top priority? Is it a lack of convincing earnings growth? Is it lack of an AI story? What's the reason that foreigners are still not looking at this market?
I think other markets, there is a tech play. They are participating in the global AI trade. Valuations in some of the markets are still not super expensive. In India, valuations, while we've been used to these high valuations, for a foreign investor taking a fresh look, these valuations are not really the cheapest right now. And on earnings, there is some conviction coming back that earnings growth in FY27 could be better, but in some cases they are looking at say FY26 not being great. So if I look at financials, for example, like FY27, there is a reason to believe that earnings growth will be super strong. At the same time, when you look at on a 2-year CAGR basis, it's still going to be like say just about double digits. So it's a combination of factors wherein they are just seeing better opportunities elsewhere right now. And that's the reason why the interest levels are still low. It's like really about chasing momentum right now. So if I look at the foreign investors, they are chasing momentum in other markets. In India, actually, if you are seeing investors are now looking at like say gold. Like say if I look at just like last month, the flows into gold ETFs were as much as equity ETF. So that way, it's about momentum, which is what is driving the market right now.
Sure, absolutely. I mean, it's all momentum investing, I think, everywhere. We talk about value investing, but ultimately all value investors end up being momentum investors as well. And we've seen that whether it's retail investors here in India chasing gold and silver, or whether it's global investors chasing the AI trade. But Kunal, let's talk about what is real here, and that's earnings. What did you think of the third quarter? Did it give you any evidence that we are actually, on track for durable 12, 13, 14% kind of earnings growth in FY27?
Yeah, I mean, most of my positivity about FY27 actually comes in from earnings. So if I look at third quarter itself, numbers were like largely in line with what the market was expecting. No major surprises, which is good. Like we did not see any cuts. So if I look at a year over the last 1 year, we are consistently seeing sharp earnings cuts. But now we are getting to a stage where earnings expectations are stabilizing. Expectations for FY27 are fairly high, and I do believe that there's a reason to have that assumption. If I look at on a bottom-up basis, financials could see very strong earnings growth, like after not having seen any earnings growth in FY26. You will have the deposit repricing benefit. Credit growth has now recovered to almost 13% levels. There should be margin improvement next year. So that sector can do the heavy lifting of getting to almost 18-20% earnings growth. Besides that, like if I look at telecoms, you will have tariff hikes which should happen. Consumer staples, autos, there will be benefits of GST. So for third quarter itself, I think results were largely in line with what the street was expecting, and that's not really bad because from FY27 perspective, the high earnings estimates of mid-teens are largely maintained after the result season.
Okay, so earnings probably is that ray of hope. So financials, you're saying, I mean, financials could get to 18-20% growth. That would be huge. What about overall consumer, Kunal? Because we've always spoken about this, the GST cuts, the income tax cuts, the monetary easing. So what kind of a pickup in consumer earnings are you expecting?
Yeah. So if I look at consumer staples, in case of staples, last few quarters, like leaving aside third quarter, have been a washout. So you've not seen any major volume growth. Revenue growth has been tepid. Margins are under pressure because of higher commodity cost. Now you have quite a few tailwinds. Like we already discussed what government has done, which is GST rate cut, income tax rate cut, interest rates have come down. Along with that, you have commodity costs which have cooled off. You have a favorable base going forward. And combination of these factors should result in consumer staples earnings growth recovering. You've seen early signs of that in the third quarter results, in which the revenue growth as well as earnings growth were the best in 8 quarters. I expect this to continue in FY27. We believe that that's a year in which you could have well above trend earnings growth of at least like say low to mid teens. And that's a quite a like a decent number for a sector which is delivering otherwise normally more like 7% revenue growth, 8-9% earning growth. That's a like potential with that sector, but we expect FY27 to be better. But if I go beyond staples, even in case of consumer durables, we did not really see the benefits of GST rate cut play out in FY26 because of adverse weather and high base. Going into FY27, we believe that if the season is okay and the fact that affordability is improved, base is favorable, you could see good numbers there. On consumer discretionary side, there are like I mean earlier we have talked about affluent consumption. That's where there's a bit of a concern emerging. While there are positives which we already discussed about, like say what's happening on the macro front, but the job additions, especially in IT services sector, is slowed down. And when you have a slow job addition, what you also have typically is lower wage growth. So that's a emerging concern. But for now, there are a few steps which have been taken by the government, and maybe few quarters down the line, you have some stability coming back there. 8-pay commission could be a catalyst. So for now, just like say, outlook is not as good as what it has been historically. but really not giving up on that space yet.
Yeah, I mean, I'm glad you brought that on the table because we have to take whatever's actually coming on board. This whole fear about IT, what it means for wage growth, if there's job losses, and if that becomes a macro headwind, is something that we need to watch. Fair point. So on earnings overall FY27, Kunal, where are you? Total at an index level or maybe your coverage universe?
Yeah. So index level expectations are 16 to 17% right now. At the same time, where you start and where you end up, there is always going to be a gap. So historically, the numbers have always been lowered. So I would expect that even if that number is say mid-teens or like low teens, that's still a good number compared to like say high single digits, which we will have in FY26.
Yeah, wow, 16 to 17%. That's at the Nifty level, right? Nifty 50 earnings.
Nifty level. Yeah. And heavy lifting has to be done by financials.
Got that. Let's see, I mean,
if banks, which is, yeah, if banks do well, I think, yeah, that's something which is critical here. That like, say you have banks delivering above par growth, you have telecoms which have tariff hike, they can do well. Consumer staples like which have been laggards, they come back. IT services at least stabilizes with some currency benefit coming in. So that can do well. Autos, we expect high single-digit volume growth. Along with that, there should be some operating leverage benefit, though commodity cost is slightly negative right now. Consumer durables come back from a like low base. So quite a few sectors in which there is a reason to believe that numbers could be better compared to what we've seen last year.
Yeah, got that. Point well taken. So Kunal, with this kind of a earnings expectation backdrop, what's the overall prognosis for the market? I mean, index level, where do you see it by the end of the year? Is it going to be another range-bound year? And in terms of just sectoral positioning, what would be your big overweights?
So we have a year-end target of 29,500, which is being driven largely by earnings. We don't expect multiples to get re-rated. In terms of sector positioning, our preference is towards domestic economy-oriented stocks. We continue to like private sector banks. Large private sector banks is something which we believe offers value and growth. We like telecoms, in which we do expect tariff hike. Consumer staples, as I mentioned, is something which we have turned positive recently after the GST rate cut. We like automobiles. On the negative side, from an India strategy perspective, we have more of like exporters or like globally aligned stocks. IT services is something which we have a negative view on. Similarly, you have cement, in which we have a negative view. Infrastructure, we've had a negative view. At the same time, budget is now like incrementally positive for exporters and for infrastructure. And finally, pharmaceuticals is something which we have a negative view on.
Okay, 29,500 Nifty target by December 26. Okay.
Yeah.
And I'm just reiterating the top overweight sectors would be private banks, telecom, and you named a couple of others. Kunal, could you just go over the top overweights again?
Yeah. So
Autos.
private sector banks, telecoms, automobiles. We like consumer internet as well, on consumer staples as well. And on the negative side, we have IT services, pharmaceuticals,
IT, and export-facing sectors. I picked that up. All right, very, very helpful conversation, Kunal, and I think we just need to wait it out and see if these earnings finally deliver, because if that happens, then that's at least one big piece of the puzzle that's been missing all this while. At least that gets in place. And then hopefully some of this FPI selling also eases out. Thank you very much, and great insights from your conversations in Hong Kong as well. Very helpful for our viewers. Thanks for being with us today. You have a fantastic day, and we look forward to more of these conversations in the months ahead. Thank you.
Yeah. Thank you. Thanks for having me.
Thank you. Well, that's the BNP Paribas view on the Indian equity market, and the Indian equity market, which is actually sliding 200 points lower on the Nifty, by the way. Check this out. We are at the morning lows, and the bulls are now trying very hard to defend 25,500. So it's a tough morning, no other way of putting it. And you don't have the problem is IT is anywhere falling, and you don't have too much support coming in from other sides of the market. By the way, the cuts on IT, HCL Tech 4%, Infosys 3.5%, TCS is down 3%. Bharti Airtel is falling quite a bit. I mean, they will be investing a lot in their new NBFC, Airtel Money. It could be some of that. It could be just overall market in risk-off mode. But Bharti is down quite a bit, 3.5%. It's fallen quite dramatically. 20,000 crores. That's the kind of money that they are pumping into Airtel Money over the next couple of years. And that's the stock, 3.5% lower at this point. So looking quite iffy. Eternal is the other one, 3.5% lower on Eternal as well. So it's basically an all fall down kind of a day. There's nothing on the counter side. If you look at Nifty gainers, not even a single Nifty stock is up more than 0.5%. It's that kind of a weak morning. Coal India, Axis Bank, Hindalco, but look at the gains. It's not even 0.5% on these stocks. So yeah, there's just a lot of caution, and now the bears are picking up momentum on the way down. 25,500. We are at the cusp of breaking that. We're still not close to the lows of the current trading range. The last couple of weeks, the low has been around 25,370. That's the lowest point that we reached. And then there was a bounce from there. The question is whether the buyers will come in. At what point will they come in? So let's see. Let's wait for this one. I think we can take a quick break. Since IT is the biggest talking point, let's do one thing before we welcome in our next guest on the show. Let's quickly run through some of the top IT brokerages once again. Like we've been telling you, it's a completely divided house. Total bull versus bear camp on IT. Yesterday, Jefferies downgraded almost every single IT stock. They cut down price targets very, very dramatically by as much as 1,000 rupees in some of the stocks. But this morning, CLSA today has come out saying that, hey, all is not lost. And some of the stocks are offering a great buying opportunity because the business models will not be totally disrupted. So let's do this, hear out or rather read out some of the top IT views, and we'll be back with our next guest in the next 1 minute. Welcome back. You're with us on Opening Bell, and it's time to welcome in our next guest on the show, Deepak Shenoy, CEO and founder of Capital Mind Mutual Fund. Deepak is, of course, a veteran with these markets. He's seen so many cycles, up and down, investor behavior, investor preferences, change, and so much more. Deepak, great to have you on the show. Sorry for the small delay. I mean, this whole IT business keeps throwing us off track. Just when we think there's enough selling in IT stocks, we get more news from Wall Street, and that's what happened last night. So Deepak, plenty to discuss, plenty to talk about, but let me start by asking you a basic question. How are you feeling as you look at the market and all the huge amount of news and noise that's hitting us constantly? You know, we're only ending February. I already feel like 6 months have gone in 2026.
Yeah, I mean, so we're less than 5% from all-time highs. So I think, the fear of the death of everything is a little overblown. Even from the market's perspective, I think, yeah, we've fallen a bit. Some of the stocks are down 30-40%, but that's okay. I mean, stocks are supposed to do that. Over time, every industry goes through a little bit of a tough time. And when they do, there is usually some kind of response from the companies themselves that talk about how they will scale. The market may believe them or may not, and suddenly at one point if they recover, then it'll show up in the earnings, and then that's how the markets are. I don't think we're unduly worried. I would honestly rather not live with the political uncertainty more than I live with the business uncertainty. So the business uncertainties are a given, but this political whammy of, oh, do we have tariffs? Do we not have tariffs? Is there clarity? All that is more difficult to live with because that uncertainty can be disconcerting. However, I think it's built some resilience in Indian industry in general. So I think that way, you should take the news as it comes. I don't think there's a doomsday scenario. Every time there's a doomsday scenario, I get very excited because I know that the markets are going to probably provide opportunities. Um, uh, I think the death of everything, including IT, has been often written in so many ways that I can't even count. From 2000 to now, I think I've heard maybe 10 or 15 different doomsday stories or around just Indian IT. So yeah, I mean, I'm sure there's challenges, but also there will be responses to these challenges. We'll have to wait to see how they go. And perhaps there will be some opportunities as well that come that way. I think investors should really focus on that rather than headline news. And with just 5% of the top of the market, these opportunities are not even here overall in the market, if I may say that.
See, the top of the market is only 5% off. Deepak, that's right. But you go down to stock level, stocks could be off 30, 40, God knows how many percent, right? When your large cap stocks, only IT stocks are down 20% in just 2 months. So therefore, I think the index has become a bit misleading to that extent.
Correct. I mean, if you're paying 50 times for cement companies and 19 times for banks, I mean, there is always going to be some wonkiness over there. Why are you paying, 38 times for steel companies? They're supposed to be single digit Ps for the most part. So it's not even the bottom of the steel cycle. So I mean, at some level, there will be some misunderstood or misconstrued valuations at some other extreme. And then, I mean, I don't think this doomsday, but it's good to have this news coming. So in spite of, the last quarter shown some ridiculously good median earning profits growth in even large caps, even I think 12 to 14% median earnings growth in the large caps. If you took just the December quarter over the previous year, more than 18% in small caps, despite having that one-time labor hit across almost all of the industry, which is a nearly 4 or 5% hit on earnings. So despite that, if you're growing at 14 to 18%, I don't feel this is a time to be, terribly unhappy. Sure, of course, AI could wipe everything out and all that stuff. But, I think that's just, I don't think that's just, I think that's the WWF of the, financial world right now. That, it's all, it seems very fake and narrative driven rather than reality grounded in reality.
Yeah, I mean, that's just how these markets have become. Things just move so quickly that you rarely are able to comprehend or have a chance to comprehend. It's just become act now and think later. That's been the texture of this market for a while. But, I just want to go back to that plate. Deepak, we were putting up some of the major sectoral holdings and holdings of the Flexi Cap Fund. Capital Mind Mutual Fund obviously has a Flexi Cap scheme and they're launching a bunch of other funds as well. What caught my attention was the cash level. Not this, let's put the the Flexi Cap holdings where cash and just investment in debt was very high. As a as a percentage of the that's the one I'm talking about, as a percentage of the total. So is that because your fund managers still don't find adequate opportunities, or is it just temporary? It's been parked there till it's deployed. I mean, I don't know what to make of it. Debt in money market at 13.7%, cash holdings at about 13%.
Yes, we've had high cash holdings recently and some hedges as well that have been taken. I think the idea here, I mean, if you look at the whole thing, it's a model-driven exposure. The model itself does not deem too high an exposure at this point, which is fine because we want to listen to the model because it tells us when things aren't looking as great. It's okay for the model to respond a little bit later to the data rather than try to take a predictive stance. So we'd rather wait for the data to come in before we would say, okay, go deploy fully. And then that's the model. The model itself will tell you want to increase deployment at certain points and you want to decrease deployment at certain points. These numbers will change on a monthly basis, right? So they're different from what you're seeing on the screen right now. It's already Feb 24th. So there are those changes because the model constantly looks at data and then comes out with what we need to do next. And then the fund managers will, vet that and follow it. So I think from that perspective, we're not saying that, oh, we're predicting a market crash. We're just saying that the model doesn't see enough opportunities yet.
Not that that inspires too much confidence. That's been the problem, Deepak, right? It's not an easy market to make money in. You have to really
It
dig
isn't.
deep and look at stocks and opportunities. It's not a momentum market anymore.
It isn't for sure. It is hardly a quality market either. It's not even a growth market. It is barely, in fact, very little value actually exists in the market as well. That's why if you do whatever factor you're trying to use to kind of enter the market, so all those factors are saying, boss, not enough. So it's like, oh, it's fallen, but it's not fallen enough so that it will be value. If it's quality, you're not showing enough quality sustainably for us to kind of take that position. Profitability, yeah, nice, but not yet enough. So that's the problem, really. It's sitting on that edge of maybe it's moving, but not yet demonstrable. The evidence is not yet there. So we may be on the cusp of a major move. Either up or down, but I mean, I'm more bullish from the economy perspective. For the stock market, I just feel like, it's been in this range for a long time. It's not going down with all the bad news, but it's not going up with any positive news either. So it's got to break through that range. It kind of, markets tend to do this at sometimes. They frustrate you at the edge. And that's the edge of frustration we are having to live through. You have to live through this time to get to the good times.
That's true. But what people are doing, Deepak, in this interim time period, is they're anyway chasing return. Gold and silver. And look at what the data threw up, right? The last month mutual fund data. 24,000, 25,000 crores going into gold ETFs. I mean, 9,000 crores going into silver ETFs. What is happening? This chase for commodities, and sometimes you worry whether it's backed by adequate reasoning and fundamentals, or whether again it's just FOMO because equities are not working, to kuch to khareedna hai, so let's buy something in commodities. What do you think of this debate?
It is, and honestly, we are also jumping into that same fray by launching a multi-asset fund right this time, right? So there's a demand for it, and there is this thing. But we found that in general, commodities perform a balancing act between an equity market that is dull and a debt market that doesn't seem to go away. There is a third layer of commodities that tends to give you some kind of cushion when things don't look as good on the other two. The problem really is which commodities. Every commodity behaves differently. So gold and silver are precious metals. Now they have surfaced because I think the lack of political cohesion across the globe has caused people to look at gold in a meaningful way from a speculative purpose, not so much as a consumption good. Silver as well, it's not a consumption good. It's right now being used as a speculative purpose. We have seen these speculative rises in the past. They last 2-3 years. They have seen 30-40% adjustments downwards as well. In the 1970s, silver went up 400% plus in 1 year. So we haven't seen anything like that yet. So it could still happen, So it's not like this is the end of that. But there is no fundamentals in most of these commodities. It's just supply and demand. So tomorrow, if there is a drop in gold and silver, there could be a rise in copper and aluminium because of industrial capex coming back across the globe, primarily because of this revolution that Trump has kind of created, which says every country is on its own, so please manufacture your own things because we will tariff you, and tariffs are becoming more and more common. So capex across people's defense industries, countries, core manufacturing industries is increasing. It may cause a rise in copper and aluminium, maybe another time further down the road. So you get that balancing act with commodities, but I think you have to think beyond gold and silver because they're not the only games in town in that have the balancing and cushioning effect against equity and debt. So that's, I mean, of course, I'm speaking, my book because we're starting a fund that creates that. But I think the demand here has come, and demand has come because prices have risen. What you said that there's no momentum in the equity markets, there's very strong momentum in silver and gold, and that's why I think so much money has flown in. In the same way that momentum tends to die when prices retreat, and therefore prices retreat even more, there is a possibility that that can happen. So anyone playing this game better know that there needs to be a way out soon. And these are not permanent holdings that you need to hold forever, and you need to maybe shift into other asset classes when the music dies. So that is unfortunately lost sometimes in a momentum market. So it's one of the things that I feel has gets overblown attention. I've always thought gold is a speculative product. We last met, I think, in a gold shop, and I was telling you that I think gold is a great thing to purchase and wear, but not such a great asset to own. And obviously,
Yeah.
asset to own seems to be it seems to
I
have gone
remember,
completely
I
wrong.
remember that conversation, Deepak. Yeah, I remember that conversation. That was in Bengaluru, I think 2 years ago, much before this massive gold rush happened. But so since then, what's the new view now in terms of just its position
No,
in
I
the
think,
portfolio?
I've come to the view that it's a good speculative asset. So in the sense of, it's like Bitcoin, in the sense that when it's going up, it's great to buy. When it's going down, it is not good to own. So you should have invested perhaps even in a Bitcoin, which has no underlying value. Gold at least can be worn, right? So, but you don't have that underlying value in Bitcoin, but still, it's a great speculative asset. You can own it for those periods of time in which it does really well. But if you look at it in the last 10 or 15 years, there are the number of times in which gold has even outperformed equity, and in some cases even debt, is not anywhere close to how equity has done, even the last 20 years. So it's at that high performance period now. It's a good speculative asset to own, but I think because it's a speculative asset, that you should consider moving to other assets when the going gets bad. And it's not like this going gets good, stays good forever. We've seen cycles of minus 40% in gold. That's the one thing I will warn in that sense, is that every speculative rise should be treated like you're buying into momentum, and therefore you should have an exit path laid out when you get in as well. So if you're doing the 24,000 crores when gold is at $5,000, do you have an exit when if gold falls to say $4,000? And then, at what point do you exit? Because at 4,000, it can't be like, oh, everybody was buying gold, so I bought gold and now look what's happened. So I would say that is one problem. The other one is the rupee. If it were to appreciate, it's done it in the past. It's appreciated 20% at various times in the last 2 decades. If it appreciates 20%, your investments in gold will fall, even if gold prices remain constant in dollar terms, because the rupee appreciates. So that is the other risk that you stand to have on a pure speculative basis. So I say that is your if that is the core of the model, you should have a model that says shift between commodities rather than stick with one.
Fair point. All right. So that's the view on commodities and on equities. Deepak, before we end, I just thought I'll, end with something on regulation, because yesterday this came up. There was an industry body meet, the portfolio managers body, and I think the SEBI chief was there, and he mentioned that there will be a consultation paper coming out very soon on PMS service providers. So it just got me thinking that, I don't know, are there any outlying issues that need to be addressed? There's always competition. There's MFs, there is SIFs, there's PMS. But is there anything actually immediate? Because you've been on that side as well. You've been running a PMS. Is there anything that really requires addressal?
Oh, I think, so I can't speak for APME, which is the industry body for PMS managers. Even though I'm on the board, I don't represent it, so I'm not a spokesperson for it. But my personal view is there are lots of growth opportunities here. PMSs themselves are advisory players alongside with asset managers, right? So in the sense of, they are the only people that can actually advise their customers because they have a one-on-one relationship with their customers. Versus a mutual fund cannot advise its customers, even if I know at best I can provide something informally, but there's no formalized structure that requires me to advise my customers meaningfully, and only a PMS can do that. And more PMSs are coming down that advisory route. They might say, listen, we are a conduit for you to invest into mutual funds. So instead of going and selecting mutual funds yourself, the advisory model can provide that. It's a much more well managed model, and it works for people who are relatively well off, because the minimum is 50 lakhs. Now, over there are complications right now. For instance, there's a lot of technology that's being built by the intermediaries of mutual funds, whether it's an RTA or something else. But they give access to advisors and they give access to even distributors, but they don't give access to PMSs as easily, because PMSs don't qualify as either an advisor or this thing. So maybe that can be something that these intermediaries can do. Again, NRIs, I think they'll need a lot of handholding in India, especially when they invest in securities. They can buy real estate easier than they can buy securities, and a lot of RBI and income tax laws have slowly been refined, but I think there is a lot of work still left to be done over there, which can ease the entry of NRIs much more easily. We've just signed a no capital gains agreement with, I think, New Zealand, and there's no capital gains, I think, already from Singapore and Dubai. So in the sense of, if people invest in mutual funds through even through a PMS, there will be no capital gains tax on people resident in those countries. So a PMS can actually be used as a structure, a conduit to invest into these things by NRIs. So I'm not saying that the regulatory bodies need to act over here. I think it's the PMS industry that can gear up to kind of serve them, and the technology that needs to be built perhaps has to come from either an industry body like APME or the service providers that are currently serving the market, and a lot more scope of growth and value is there. There will always be competition. That competition will never. It's a good thing that we have competition, but I think everybody forms a different role. You're talking about PMS as hand-holding, advisory-led relationships. An SIF is a non-advisory asset manager, which is primarily has some extra features compared to a mutual fund, which is also an asset manager, and both these cannot advise. You have the pure advisory models who cannot manage. So they're all different, but they target the same customers. I would say over here, the industry needs to just, collaborate, because all of them can kind of provide services in a better way to the same customer. Eventually, even as a PMS, will benefit from the massive, financialization that's happening.
All right, great conversation. Thank you very much, Deepak, for joining in. So many interesting issues to discuss, right? And thank you for weighing in on all of them. We look forward to being in touch. Have a great day. Thanks.
Thank you so much, Subi. Thank you and take care.
Yeah, you too. Well, with that, we are out of time on this edition of Opening Bell. It's 5 minutes past 10 o'clock. The market stabilized. It's not a wide fall on the Nifty. It's about a 200-point drop. But it's not breaching, at least right now, it's not breaching 25,500. So as we wind down this edition of the show, let me leave you with a very, very interesting snippet of a conversation between Lata and SBI Chairman C.S. Setty. They discussed a whole range of issues, including growth, including, of course, how regulation is evolving. But one of the most interesting aspects was the discussion around the hunt for deposits. How banks are battling the flight of deposits towards mutual funds as Indians are investing more than ever before. Well, Mr. Setty said that Western economies have tackled this shift from bank deposits to mutual funds by expanding their balance sheets beyond deposits into market instruments. So this is a conversation, Lata and the leaders. Here are the snippet. Thank you so much for watching.
Look at your loan growth and your deposit growth. Deposits at 9% growth and loan book at 15.6%. You all can't continue like this, isn't it? Ultimately, the end product has to grow only if the raw material, which is for you, deposits, grows. Isn't this going to become a structural issue?
So there is definitely a flywheel impact in the sense that the credit is a multiplier. Some amount will come back as deposits.
Yes.
But I do agree, at the system level, the gap of 5 to 6% is unsustainable. That means, we need to it always finds an equilibrium. Initially, the credit growth will add to the deposits, but if credit growth is fueled further, and there could be a moderation in the credit growth and deposit, they find an equilibrium.
Yeah.
This has happened in the cycles in the past.
Yes, it has happened,
and
this time
we are
it was
seeing that.
exacerbated by the fall in CRR.
Correct.
So that raised the money multiplier. I take your point, but there was a Reserve Bank study which an analyst pointed out to me that I think it was in 2024, a study showing that whenever credit grows much faster than deposits, what normally happens is credit slows.
Yes. It happens, and this is what I say, equilibrium will be found, but whether that slowing down is significant, and how do we address without it getting slowed down is an important element.
But are you looking for any, are you in discussion with the DFS or with RBI, more so with RBI, on whether you need more instruments? For instance, you all can raise CDs up to 1 year. Is there a discussion that we should be allowed to raise longer CDs? Any discussion happening on addressing what is looking like a long-term problem? Deposits are not going to be, like my father put all his savings in fixed deposits with banks. That period is over.
Yeah.
People are going to put it in mutual funds. So how is the discussion happening?
So to rephrase your question, before we go to the RBI,
Yes.
I think it's a structural problem. And this structural problem is here to stay. Earlier also I mentioned in my earnings call also I mentioned that the movement towards other financial instruments is irreversible.
Yeah.
There could be some movement here and there, markets are performing well, people will probably move more. But if you see the systemic investment plan itself is contributing significantly towards that, and we see a large growth happening in the insurance and pension.
Yeah.
While we keep talking about mutual fund industry, we do not pay as much attention in terms of the growing. While we still need a lot of insurance and a lot of pension here, but the financialization of the household savings, apart from the deposit, is happening is irreversible, which means that this structural problem, it may not be immediate problem, it may not be immediate problem for banks like us, but smaller banks will face the problem.
Yes.
And the cost of intermediation will go up when they want to pay more for the deposits. I personally believe that we need to have a different way of structuring our balance sheet. And today, if you see, 99% of our balance sheet is built by deposits.
Yes.
Whether it is investment portfolio or loan portfolios, primarily is built by deposits and a bit of capital. But if you go outside India, Western countries, it is about 65 to 70% deposits contribute, and rest is market instruments. So as you have said, I think there is a need to relook at what kind of market instruments will be made available. Not necessarily the long-term series, that could be one of the possible solutions, but I think the securitization market has to improve. Today the securitization is not significant. Asset-backed securitization in India is primarily non-mortgage securities, whereas mortgage book is growing pretty high, and we ourselves probably will hit 10 lakh crore in mortgages. 10 lakh
you're
crore.
already, I think, 8
We
lakh
are
crore
8.8,
plus.
and we'll soon be reaching the 10 lakh mark. So, but how do we bring this mortgage-backed securities much more, maybe even retail mortgage-backed securities? While there is some movement in that, the challenge in market instruments is that everybody would be benchmarking to the government securities.
Yes.
And when the yields are elevated, and when we compare with our deposit rates, it doesn't really add up.
Yeah.
So the simple question is, it's nothing to do with the RBI.
Yeah.
RBI has never
the
stopped
market
anyone.
has to evolve.
Market has to evolve, and market participants, people like insurance companies, mutual funds, pension funds, who are staying away from non-GSEC markets have to come into this.
Fair point, sir. Development of the corporate market, that is another theme I have discussed ever since I started business journalism. But yeah, we have started it on InvITs and REITs. We are circling assets. Hopefully we will come down to retail assets also being circled faster.